$1 million question. Who saves and who pays more by moving to Italy? Italy has also become a tax haven for certain groups of individuals. On the flip side, for some, moving to Italy could mean a higher tax burden. So in this video, of course, based on my experience, based on my knowledge, I would love to take a look about who pay more and who pay less by relocating to our country. Let's understand the Italian tax system first, okay, the average. Italy loves to apply a progressive tax system, with rates ranging from 23 to 43% for individual income, plus regional and municipality charges, which can add an extra, let's say, 1 to 3%. However, during the last, let's say, 6 to 10 years, our government has offered several tax incentives just designed to attract high net worth individuals, people retired from work, and people active working, like self-employed or working remotely. So at the same time, those who cannot access to these incentives may find the combination of income tax, social security contributions were due, wealth taxes, and VAT, the IVA, really heavy to play with. Let's start with who saves or who can save more by moving to Italy. Well, high net worth individuals on top. Italy offers a flat tax regime for wealthy individuals who decide to establish residency in Italy as permanent residency tax-wise. Under this scheme, qualified individuals can pay a flat tax, a lump sum one-off per year of 200,000 on their foreign income and assets, regardless the amount. And this tax incentive is very attractive for those who have, significant income and several assets abroad. Let's consider John, for example, someone that is retired from work, is an investor from the UK and earns 5 million annually in dividends from overseas investments spread all around the world. If John moved to Italy and opted for the flat tax regime, his foreign income would be taxed just 200,000 per year. No wealth tax, that's it, 200,000. Without this scheme, as an average, if you want taxpayer, he might face an effective rate of more than 43%, like owning more than 2 million in taxes. So by moving to Italy, John can save an impressive 1.8 million in taxes each year. Let's now talk about people who retire for work. Of course, nothing comes free of charge. People retired from work receiving a foreign pension can benefit from the 7% flat tax regime, but the cost is available only for people retired from work who relocate to specific southern regions, like for example Sicily, Calabria, and so on, and Puglia, and decide to live in towns with a population lower than 20,000 inhabitants. And this incentive, believe it or not, applies up to 10 years. Let's pick Mari, an American lady retired from work. She receives an annual pension, 401k, social security combined of 50,000. If she moves to a qualifying town in Sicily under the 7%, she would pay, easy to do the math, 3,500 in taxes per year, compared to around 10,000 under the Italian standard tax brackets. So if you do the math, in 10 years, she can save more than 60,000. The last one, people working, remote workers, professional. There is a pretty nice law that goes by the name of Regime Impatriati, Impatriate Tax Regime, where highly skilled workers and self-employed professionals can benefit from the 50% exemption of the income that comes from employment or self-employment. Previously, just to make you feel bad, it was 70 or 90% if you move in some regions. Nowadays, it's just 50%. This incentive was extended to 90% for those relocated to southern regions, but then, it was closed in 2023. The regime is still valid for 5 years, stick at 50%, and can be extended to another 5 years under certain conditions. Let's pick Sofia, a software developer who earns 80,000 annually working remotely for a US-based company. By moving to Italy, she qualifies for the Regime Impatriati, high skill position, so she can reduce her taxable income just to 40,000. So The brackets will be estimated just on 40,000, 50% of the basis. Her effective tax rate, including subcharges, would be approximately around 25%, resulting in the net tax liability of just 10,000 against the 80,000 gross. Without this scheme, she should have paid around 27,000. So with the beneficio impatriati, she can save around 17,000 per year. Now, let's reverse roles. Who pays more by moving to Italy? Well, middle-income professionals without tax incentives. Our progressive income tax system can be challenging for middle-income earners, in particular way for those that were not eligible for the regime impatriati or any flat tax regime because it doesn't pay off, or simply because you don't reach a certain threshold. Combined with the high VAT, around 22% original taxes, the cost of living, managing your fiscal position, and taxation in general can be definitely higher compared to a lot of countries. Let's say James, okay, an engineer from Germany who earns 50,000 per year gross. In Germany, his effective rate is 30%, rounded up, so resulting in a gross liability of around 15,000. In Italy, after factoring an income tax and subcharges, James would pay around 17,500 plus, local taxes, plus higher living expenses due to the VAT, to the 22%. So this results in an annual tax increase of 2,500. Of course, we're not talking about the willing to stay here because he loves Italy, okay? Just purely tax-wise analysis. What about business owners and entrepreneurs? Well, Italy corporate tax rate is a flat 24%. So while this rate sounds competitive, the overall administration burden and compliance cost can make Italy less attractive for entrepreneurs. Let's say you're a French entrepreneur, okay? You run a small IT consultancy with a profit of 200,000 per year. And you come from France. So in France, your effective corporate rate is, 15% for the first 38,100 and so on, and 25% for the rest. So roughly speaking, you should owe to France just 40,000. In Italy, with the same income, you should pay 50,000. So moving your business to Italy will cost you another 10,000 per year. That's a premium you have to pay for. What about wealthy individuals without foreign income? Because, for example, for whatever reason, you decided to cash out everything and you invest everything in the Italian market. While the flat tax regime, the 200,000 benefits though with substantial foreign income and assets, individuals who earn primarily within Italy may face higher tax rate compared to other countries. So strictly by this definition, it seems like you would be penalized by moving your money to Italy. Let's say, Mario, an Italian-American dual citizen who earns $1 million annually through a local business and real estate rentals in Italy. Under the standard brackets, his income tax liability would exceed the 400,000. Flip side, if he remained in the US, his effective tax rate would be around 350,000, saving him 50,000 by not moving to Italy. Or, in other words, if he would qualify for that, he would pay just a flat tax of 200,000. But unfortunately, his asset and his portfolio is in Italy. Don't forget about the wealth tax on financial assets held abroad and real estate outside Italy. For example, financial assets nowadays are taxed at 0.2%, and foreign real estate on 1.06% of its value, minus, property taxes that might be credited. What about inheritance tax and gift tax? Well, rates here in Italy are ranging from 4% to 8%, with, of course, significant exemptions to close relatives. But definitely, this can be a deciding factor, a main factor for those planning to invest in real estate. Italy offers a pretty mixing landscape with a dual narrative. A lot of savings for those who qualify for its incentive programs and higher tax burden for those who do not. It is pretty unfair. On one end, high net worth individuals, people retiring from work, and skilled professionals and workers in general can really gain money on generous schemes, while middle income earners, average, if you want, local business owners may face increased cost just by moving. This decision to move to Italy should be guided by really careful financial planning. I might say that consulting a tax advisor familiar with Italian and international tax laws is the main step to navigating this complex case and this scenario. With the right strategy, you can definitely turn Italian tax system into an ally rather than a burden. With its mix of incentives and challenges, Italy is a land of opportunity for the right kind of taxpayer.